Hello, I'm Craig McCann. I'm here today on behalf of the InvestorsAdvocate.com to explain to you why I think you should not buy an oil and gas DPP. DPPs, or direct participation programs, include non-traded REITs, non-traded business development companies, oil and gas partnerships, equipment leasing partnerships, and managed futures. DPPs are a liquid, poorly diversified investment saddled with high fees. Their potential tax benefits are small, often less than their upfront fees. Traditional risk-return analysis exposes DPPs' extreme disadvantages for investors. Oil and gas DPPs promote the tax benefits investors can achieve through write-offs of intangible drilling costs and depletion deductions. The write-offs and depletion deductions can only be applied to passive income if the investor is a limited partner. Some oil and gas DPPs are registered with the SEC while others are not. None are listed on a public exchange. Not being registered with the SEC reduces transparency and exacerbates the sponsor's conflicts of interest. There are many conflicts of interest. For example, the managing partner is compensated mainly through large upfront fees, other fixed fees, and markups on drilling costs rather than on the profitability of the oil investments. Oil and gas DPPs are extremely speculative. First, they're concentrated in the development of new wells, pipelines, production facilities, and other infrastructure projects. These projects typically have no significant operating history. The sponsors may sponsor many programs which compete with one another or face other conflicts of interest. They have high upfront placement costs of approximately 10%, plus marketing and other costs of approximately 5%. These costs are largely used to motivate independent broker-dealers to sell oil and gas partnerships to investors like you. Finally, since oil and gas DPPs are not listed on an exchange, there's no liquid market, which often significantly limits their transferability. Let me give you an example. This is Atlas Resources Partnership number 18, issued in 2008. It had upfront costs of 15%, which you can see in the prospectus for this program. And Atlas's 10K for 2011 includes a discussion of their business model, and it says, for instance, that as a sponsor they also receive additional interest in each partnership, typically 5 to 10% for operating the wells and managing the general partner. Atlas also discloses in its 10K that it earns a myriad of fees on the programs that it manages. The upshot of all of these fees, you can see in this graph, is that Atlas's programs have substantially underperformed diversified portfolios of oil and gas operating companies. I've plotted the cumulative returns up through 2007 against Vanguard's Energy Mutual Fund and Fidelity's Energy Mutual Fund, and you can see that the Atlas programs in the blue dots have done much poorer than the Vanguard and Fidelity funds. We can put a finer point on that here by looking at the annualized returns through December 31st, 2013. These are all 19 of the public Atlas funds formed since 2000. You can see that the Atlas funds returns in the first column of percentages are mostly negative, really quite substantially negative, whereas the same investments during the same time period in Vanguard's Energy Mutual Fund would have earned positive returns for all but two of the funds, and on average would have had a return of 9.24% compared to the Atlas Fund's average return of 20.73%. That is, on average, the Atlas oil and gas partnerships had a lower return than the Vanguard Energy Mutual Fund of 29.7% per year, 0.97% per year. The non-traded investments or direct investments trade association, called the Investment Program Association, claims that direct investments or direct participation programs, including oil and gas DPPs, expand the asset classes available to investors and allow for greater diversification. That's untrue. Oil and gas DPPs, or direct participation programs, have the same exposures as oil and gas operating companies that are listed on exchanges, except those exposures are repackaged into illiquid securities to hide the true costs and allow affiliated party transactions, which would otherwise be illegal. Alternatives to oil and gas DPPs. If an investor wants to have exposure to oil and gas operating companies, investors can achieve that exposure through oil and gas exchange-traded funds or oil and gas mutual funds, which are much cheaper and more liquid than oil and gas DPPs. Because of oil and gas DPPs' extremely poor returns, high offering costs, and conflicts of interest, it's our view here at investorsadvocate.com that no investor should purchase an oil and gas DPP. Investors would be better served purchasing a low-cost energy exchange-traded fund or mutual fund if they want concentrated exposure to the oil and gas industry. Thank you.